Hello, my name is Rodolph LAURENT, RODOLPH LAURENT, and Executive MBA Smartly student for April 2019. I'm here in this video to present you the case study for markets and economics. My choice is to talk about the Brazilian stagflation, and in which I need to answer this question: would you recommend that Tomini continue to raise interest rates? Why or why not? I will start before to finally answer this question by analyze the situation based on the material in the case study. So first, after the financial crisis between 2009 and 2015, economic growth, unemployment was low, and inflation was in middle high level between 4 and 6%, a little bit more than all the developed country, but it was respecting more or less the Phillips curve, which relates the inverse relation in short term between inflation and unemployment. In 2014, the inflation started to accelerate when the exchange rate of Brazilian real fell. You can see this in this exhibit, making import costs higher, creating even more inflation. In 2015, due to high inflation, the spending power of the Brazilian fell. So it's reducing the aggregated demand and then reducing the short-run aggregating supply, and then raising unemployment. If the interest rate were higher and exchange rate stable, that would have led to a decrease of inflation. But the low cost of money borrowing plus the low exchange rate of the Brazilian real created an auto-realizing inflation expectation, see in Exhibit 7. Indeed, in this case, the Phillips curve was no longer relevant because we were in a longer term inflation. And here you can see that the people were expecting more inflation in this exhibit, and then this happened. A similar phenomenon appeared in the oil price stock in the 70s in USA, as explained in the case study material. Ultimately, of course, the GDP fell following Hawkins' law, which relates the relation between the unemployment rate movement and the GDP. Indeed, it says that 1% raise of unemployment, GDP will be about 2.5% lower than potential GDP. And then we can also see that by the leading KPI, which is the unemployment rate. Everything considering, due to the fall of the exchange rate plus of interest plus the lack of bank independence, the investment in Brazil from outsider probably fell also, decreasing outputs. A low exchange rate could have made the good from Brazil cheaper for foreigner, but the difficulty to make business Brazil, you can see that in the exhibit 8, comparing to other country, probably stopped the export to grow and the price to fall as it should have been in a normal situation. In addition of all these issues, the government expansionary fiscal policy plus the increase in debt, the quick increase in debt, we can see that in this exhibit, had probably reinforced the inflation and the defiance of investors. With this analysis, we can now answer this question: would I recommend that Tomini continue to raise interest rates? Only one reason could lead us to answer no. It's one simple selfish reason to not do so. It's to save Tomini's job. Indeed, the short-term effect of lower interest rate could have some positive effects on unemployment, helping Dilma Rousseff to be able to win the short-term election and relieve the pressure on Tomini, because Tomini is not independent with the government as it could be in other area as the European Union, for example. But, and this is my answer, there is a lot of reason to raise the interest rates. So first, the capacity to ease the business in Brazil in short term is very low, as already shown in this exhibit, and would take too much time, even if it could stabilize the economy by increasing the exportation, even more possible with a low exchange rate for the Brazilian real, and it's clearly explained in the material of the case study. So it would reduce the cost and then the customer price, but it's not possible in the short term, in the short time, in which Tomini needs to act. Second, as shown in the material of the case study, and during the oil price shock of the 70s in USA, the inflationary pressures typically continue to build rather than subside once the inflation expectation begin to rise. You can see that in the exhibit 7. We are clearly in this situation. Because here, due to the recent inflation history and the reluctance of Tomini to stick to his inflation commitment due to his fragile position under Dilma pressure. So yes, Tomini should have raised more interest rates and it would have been the best solution for the country. Why? First, and of course, it should have been done even before the stagflation area, because inflation rate was already high enough to lead Tomini to increase the interest rate before 2014. The unemployment rate rising in 2014 was already a leading indicator of a start of a recession, meaning as the inflation was still high, plus exchange rates were lowering, there were a high risk of stagflation. So in emergency, they needed to increase even more the interest rates. The second point, they need to have raised more the interest rate to stabilize and reduce inflation rates and take back the economy to an equilibrium, probably an equilibrium lower than the potential GDP. But it's an equilibrium from where the Brazilian economy could restart an economic cycle from the through of the recession, with the possibility to reuse and retake position of the monetary tools, as increasing the money supply, lower the interest rates in the short term, and to follow the government discretionary policy plus automatic stabilize. Only this to allow to manage inflation and maximize employment without the long-term risk of inflation as the stagflation in which they are now. So the only solution to avoid this stagflation is to start with probably a painful solution, but to really raise significantly the interest rates. Another point, another reason to do that is to rebuild the foreign investor confidence investing in Brazil by showing them that the central bank can take corrective and courageous action when it's needed, and offering a higher interest rate and lower the risk for foreign investor. Another point, of course, is to be able to increase the Brazilian real exchange rate, and so decreasing the cost of import and then limiting the inflation. Everything of this is not possible without increasing the interest rates. Another point is to be able to control the inflation on the long term and avoid a new period of stagflation, as already shown before. And that would have, of course, a negative effect on the economy and employment in short term by decreasing investment and then sell. But the price after can follow and fall, and we can control the inflation. But and it will rebuild the basic of the economic and stabilize the Brazilian economy. Of course, all other structural government change should have been done in the meantime, increasing the general wealth of the economy, and so the GDP through the Canadian solution, government intervention and to increase the aggregated demand, or supply side solution, reduce tax and regulation, or even an hybrid solution with a little bit of both, as done by Obama administration after the Great Recession in 2008. But in any case, they should have continued to raise the interest rates. Thank you.